Hello, and welcome to the latest market briefing from Refinitiv's oil research team in the Middle East. The team here has recently published an extensive special report on the Iraqi oil sector, and for this episode, we're going to share some of the highlights from that publication. We will kick off with a look at recent OPEC developments and Iraq's role in the global crude market, after which we will then turn our attention to Iraq's fuel oil fundamentals and exports. Now, after giving the markets a bit of a scare in July, the OPEC Plus alliance is very much back on track following the rift between Saudi Arabia and the UAE. The timeline here shows recent history of OPEC Plus cooperation, which began in May 2020 and was due to end in April 2022. July's fallout occurred when Saudi Arabia proposed extending the agreement from April to December 2022. We will look at that in more detail in just a moment, but in the terms of barrels back to market, here's the latest. In May, June, OPEC increased output supply by 350,000 barrels per day each month. In June, that rose by a further 400,000 barrels per day. As for the latest agreement, OPEC Plus will continue to return 400,000 barrels per day in production each month through to December 2021. Looking to next year, the original agreement was due to end in April. However, it has now been extended to December, and this is not without conditions. From May to December, new output quotas have been agreed for some members. The UAE baseline will increase from 3.17 million barrels per day to 3.5 million barrels per day, with an increase of 330 kbd. Saudi Arabia and Russia will raise their baseline from 11 million barrels per day to 11.5 million barrels per day, up 500 kbd, and Iraq and Kuwait will each have their baselines changed by additional 150 kbd. Now let's outline why exactly the UAE dug its heels in July. Now take a look at these charts. Black bars show June 2021 production. Blue bars show max monthly production seen since the start of 2015. Which we will use as a proxy for production capacity. Now, if we compare these numbers, we notice considerable variation in permitted production as a percentage of total capacity. Angola is very much an outlier, pumping at 60% of its implied capacity. Then we see UAE at 70%, Nigeria 73%, Saudi 77%, Kuwait 78%, and then Iraq way out in front, pumping at 84% of capacity. Now, the UAE's historical output reached 3.85 million barrels per day, and the baseline it was actually being held to by OPEC was just 3.17 million barrels per day. So you can understand they were feeling a little shortchanged there. Now, based on these numbers here, we see that the UAE has 30% of spare production capacity. By comparison, Iraq is only at 16% spare capacity. So that's essentially a 14% difference, which is not insignificant. So in fact, what is the significance of that? For the UAE, in volume terms, it's 540,000 barrels per day of oil production. And in dollar terms, it's more than 13.4 billion in annual revenues. And that's based on $68 per barrel Brent and not the OSPs. Now for Iraq, that 14% again, for Iraq, in volume terms, it's 760,000 barrels per day of oil production, and in dollar terms, that's 16.5 billion in annual revenues. So it's a lot of oil, it's a lot of money, it's not something to overlook. So it may be argued, therefore, that the UAE quota adjustment is in fact warranted, even though Iraq got another 150,000 barrels a day, despite the fact that it consistently breached production targets. Let's turn our attention and look more closely at Iraq now. Now, as we found in a recent study of the Iraqi oil sector, expanding production capacity may actually be a hard-fought battle for Iraq. In the long term, tapping reserves and expanding capacity requires significant investment, and this is an area in which Iraq is facing some significant headwinds, particularly given the fact that a lot of IOCs are starting to exit the country. In the short term, Iraq must address the return of Iranian barrels and the challenge to global market share. Now, the charts here show key buyers of crude exports from Iraq in the top chart and from Iran at the bottom chart. Now, in both cases, India and China are the top of the list of buyers, while there are also sharing markets in Southern Europe and in Asia Pacific. We also know that Iraqi and Iranian export blends have very similar quality criteria, so essentially cargoes can be easily switched in and out by refiners. An end to US sanctions from Iran will be welcome news for oil importers, especially if Iran discounts barrels to regain market share as it has done in the past. For Iraq, however, it represents a significant threat to market share, to global oil prices, obviously, and therefore to national revenues. And we think it is likely, actually, that Iraq may be forced into a price war with Iran by lowering official selling prices on term contracts and or pricing barrels into alternative markets such as the US. Now, it's worth noting that OPEC commitments do not cover refined products output, only crude production, which is difficult to monitor and relies on export assessments as a proxy. The cap on crude production means that fuel oil exports provide an important source of forex revenue for the Iraqi government. Iraq is a major fuel oil exporter in the region, and we're seeing loaded volumes run consistently above official numbers reported to Jody. Now let's jump in and take a look at fundamentals in Iraq's domestic market. Looking first at demand, we can see the purple line in the top chart. Iraq fuel oil demand has taken a major hit through the COVID-19 pandemic. According to Jody data, domestic consumption averaged 136,000 barrels per day in the first quarter of 2021, and that's compared to 254,000 barrels per day in the same period in 2019. So this represents 46% reduction over the 2-year period. Turning to supply, what is interesting is that refinery output is little changed despite the drop in fuel oil demand. Take a look at the blue bars in the top chart there. Average fuel oil production fell to 318,000 barrels per day in the first quarter of 2021, and that compares to 340,000 barrels per day in the same period 2020. So we're seeing sustained output in spite of low demand. Iraq's resulting fuel oil surplus has spiked 244% through the COVID pandemic, and that is reflecting the rising fuel exports in the bottom chart there. A comparison of Jody fuel oil production and consumption data shows that Iraq had a fuel oil surplus of 180,000 barrels per day, or 880,000 metric tons per month in the first quarter of this year. The extent of that surplus is considerably higher than pre-pandemic Iraq, whereby the surplus stood at 53,000 barrels per day, or 250,000 metric tons per month. Let's take a closer look at the downstream operations and fuel oil supply. Looking at the refinery system, we see it has a relatively modest capacity and low complexity. IIR data, which underpins these charts, shows that just 3 plants are responsible for more than 60% of primary processing capacity. Those same 3 plants in Basra, Dawra, and Erbil also dominate secondary processing capacity in the country. Basra and Dawra refineries have a combined 80,000 barrels per day thereabouts in residual upgrading capacity, and that includes a VDU as well as asphalt, bitumen, and lubricant units. Now, the lack of upgrading capacity relative to primary capacity means that Iraqi refiners have a large overhang of high sulfur straight run fuel oil, which needs to be exported. So let's take a look at fuel oil export volumes. And what we start to see is the presence of a very important delta. Looking at the top charts, export volumes based on Refinitiv ship tracking data show that monthly volumes are generating or running above the implied surplus of 880,000 metric tons per month, as per the exports reported to Jody. Now, to be more specific, we observed that our data runs about 75% higher than Jody data for the first quarter of 2021, with an estimated delta of 128,000 barrels per day in fuel oil exports, which is by no means insignificant. So we kind of wonder where that delta might be coming from. And without dwelling on the cause too much, there is speculation within the market that Iranian fuel oil supplies are being disguised as Iraqi cargoes and therefore augmenting the observed exports. It's worth noting the proximity of Iran's 400,000 barrel per day Abdan refinery to SOMO's official fuel and export hub of Kaz Al Zubair. So let's discuss the direction of fuel oil flows and who's buying. Now, because of its high sulfur content and low viscosity, Iraqi straight run is actually more suitable as a refinery feedstock than it is as a direct bunker fuel for the shipping or power sectors. As such, we see the refineries tend to dominate fuel oil buying. And the latest fuel oil tender from SOMO, which was for 750,000 metric tons per month, we see that Chevron took 50% of that, and Reliance shared the remaining 50% allocation with an Iraqi trading company. Now, if we look at the bottom charts, we see that discharge destinations, India and Korea are among the key off-takers for Iraqi fuel oil over the past 2 years, and Indian demand has remained relatively consistent through that period. Meanwhile, the United Arab Emirates has taken over from Singapore as the major off-taker or the primary off-taker, which coincides also with the transition from low sulfur marine fuels in 2020. So let's drill down a little bit closer on the data. We see here that the blending and trading hub at Fujairah, or the UAE, is now the main offtake point for Iraqi exports, which are then re-exported and quite commonly to Southeast Asia or to East Africa. Focusing on the 2021 dates, we see the total exports have dropped in the second quarter, and that coincides with the seasonal increase in Middle East power demand. If we look at the blue bars, these seem to have shown that, well, we see that the UAE's share of the market has lowered during this period. India, the teal bar, volumes have also dropped through the second quarter, and that's possibly due to domestic fuel sales or lower domestic fuel sales and lower refinery runs amid the latest wave of the COVID-19 pandemic. And coincidentally, there has also been an uptick in direct flows to Asia, with China in the light grey bar and South Korea, the dark grey bar, both taking more cargoes directly through the second quarter. Now, this relates to an increased demand for fuel oil as a feedstock in Asia, where fuel oil cracks are weak and crude prices are high. And this suggests there is good margins in fuel oil upgrading in the region. Trade economics aside, there is a regulatory issue at play here as well. Importantly, China's independent refiners have been hit with tighter crude oil import quotas and also changing tax regulations. This has increased their dependency on fuel oil as a feedstock and could result in sustained demand for Iraqi fuel oil exports going forwards. Now, this is going to be the subject of an upcoming special report, so keep a lookout for that. Now, with that, folks, we'll bring this session to a close and invite you all to join us again in August. Look forward to seeing you.